Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, and here's where we start to get into where I think traders get pretty confused. They'll look at that number, this bottom line, and they'll say, well, shoot, it seems like investing in the OTC, the leverage there works much more to my benefit versus in the options market. But right now, we're in a state of flux in the industry. So we've got one thing that we got to deal with, keeping our minds on one side of this equation, that these numbers may in fact change just based on what they are right now without any modifications. The other thing we have to consider is the nature of an investment in the spot Forex versus a buying an option long, because there are a couple of advantages to buying the option long that it can't be, you can't replicate those in the same way just with a spot FX position. So let me explain. Let's run through a couple of changes here in this calculation and see what happens to our numbers. What if our FX leverage gets changed? So, for example, what if all of a sudden the maximum leverage you can get, which is one of the things that we're seeing kicked around right now, is 10 to 1. All of a sudden this changes things very much, because if we want to control essentially the equivalent of a mini contract, we got to post $1,000 in margin. So now you can see, on the extreme side of this, depending on what ultimately comes down in changes in leverage, all of a sudden our best case scenario begins to look very different. But let's put this back. I think one of the questions that we have to ask ourselves is, as traders, is, if I do see a move, a trade that I think has, so I'm looking out a couple of months, so, maybe it's got an upside potential. If everything works out and the pattern confirms or whatever it is I'm looking at, I think that's maybe got 1,000 pips worth of upside potential. So we can move 10 cents in the exchange rate. What is that? How many times am I going to get stopped out to capture that 1,000 pips, right? So am I setting a 200 pip stop loss to get 1,000 pips? That's still a 5 to 1. Am I using 100 pips? That's a lot tighter, and I'm going to get stopped out a lot. So in order to get 1,000 pips, how many times am I going to get stopped out in that same trade that I got to get back in order to take advantage of the entire move? Does that all of a sudden move my, if I project that I could make 1,000 pips, but, I got stopped out a couple of times, does that then reduce my upside to, 800 pips or 600 pips as I manage this position? Where all of a sudden, that stop loss management, which is kind of the go-to strategy that Forex traders rely on to manage their risk, to fix their risk as to what's my maximum loss, it's generally fixed at their stop loss. Well, one of the inherent disadvantages of a stop loss is you get whipsawed all the time. It's just, that's reality. There's no way to avoid it. And that is one of the things that we deal with. So the question is, how many times does it happen? And it's really, I think it's a question you got to, everybody's a little bit different, because I know a lot of traders are willing to get stopped out a lot more on a smaller stop versus a larger stop and get stopped out less, but their worst case scenario is obviously much larger. And so your individual characteristics may be a little bit different. Now, so you'd have to adjust this, but all of a sudden you'll notice what's happening to our numbers down here. Things get a lot more equivalent. And then, with options, the reason why I'm bringing up stop losses on the FX side is that, I think we should answer the same question here with what's our maximum loss if we were to buy a put option on EUU. Well, our maximum loss, you could theoretically set stop losses there too, but but I'm not going to address stop losses in the options market. What I'm going to talk about is, what if you didn't set a stop loss? What's your maximum loss fixed? Fixed at the purchase price. So let's say that you thought the market was going to drop, and sure enough, you get in and the market goes down a little bit, and then boom, shoots right back up. On one side, you're going to be stopped out, and you have to make a decision: do I want to get back in? Or on the option side, you're already in. Sure, the option is not worth very much, so you've acquired some losses, but since you can't lose any more than $230, you could stay in indefinitely until expiration if you really wanted to. because the further the market goes against you, you only have X amount of losses. So you could stay in. So if the market moved 500 pips away from you and then corrected and went the direction you forecasted, you're still in the trade. So you didn't necessarily get stopped out and churned out of that trade, which is one of the key differences between being long and option, is that you already know what your maximum loss is, even if you stay in the trade all the way through expiration, regardless of what direction the market actually went. So let's say in our example here that that we hold on to this position all the way through till expiration, 2 months worth anyway, and it turns out the market just kind of channels in the last couple of days. It moves against us to the tune of 300 pips. All right. On the FX side, we've lost. So we have some leverage here. We've lost 300% of our margin. So we've lost a significant percentage of what we had invested. And on the call side, we haven't lost, or on the put side, on the option side, we haven't lost the same amount because we've been fixed. So what if it got even worse than this? What if we just really stuck to our analysis? We had one of those trades that just goes really bad against you. We could continue working these numbers to make our point, but the trade-off that we're giving up by taking advantage of a little bit less, off-the-shelf leverage is we're getting the ability to stay in a trade already knowing what our maximum loss is no matter what happens to the market, and not having to necessarily worry about being stopped out one or more times. So you can see here, let's say this trade just went really bad, down 700 pips. And on the one side, we've lost 700% of what our original margin requirement was. We would have given up $700 out of our account in losses, versus, we've lost 700. We haven't lost $700 here on the option side because we had it fixed at $230. It's the most we could lose. We could lose 100% of what we had invested, but no more. One of the big reasons why I find aggressive options traders who are interested in the Forex beginning to trickle over into the currency options market, because they can see these trade-offs work to their advantage. Okay, so I'm going to go back to the chart. Now, in order to run that comparison, we made a couple of assumptions. Just to reiterate what those assumptions were, one of which was we assumed that in either case we were holding our position all the way through till expiration. So there are some variables when you're trading options that you don't have to hold it through expiration. I always get that question from Forex traders as to, well, what's the restrictions? And a couple of rules of thumb. Depending on who you talk to, every options trader has a little bit different opinion than this, but you'll hear this very common, and I would suggest that, usually, when you're buying an option, you have a time limit. So you have an expiration day at which point that trade's going to end on that day or before, sometime before if you choose to. But how much time do you buy? I usually say, well, you buy twice as much time as you think you're going to need. This is a rule of thumb. And in general, the further you go out of the money, the lower that option costs, but which may be good, and that effectively could increase your quote-unquote leverage, if you will, by a lot. But the chances of that position turning up to be a loser is much higher. So you're always kind of trading off this risk for reward, which I think is true in the Forex market as well.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.